Welcome to the Explainer. Okay, let's dive right into this fascinating dynamic unfolding with ADP's recent financial performance. If you follow the markets, you know the payroll giant has been making some serious waves lately. But underneath the headline numbers, there's this highly strategic chess game playing out between macroeconomic headwinds and some really aggressive corporate capital returns. To set the stage, ADP's stock actually took a pretty decent tumble recently, dropping roughly 20% from its 2025 highs. And, this wasn't driven by some catastrophic internal failure. It was primarily driven by a cooling job market. Because think about it, when hiring slows down across the broader economy, investors naturally get nervous about companies whose revenues are directly tied to headcount. But here's where it gets really interesting: the dichotomy of it all. While Wall Street was selling off, ADP's management fired back with a massive buy signal. Instead of retreating, the board of directors stepped up and authorized a brand new $6 billion share repurchase program, completely replacing their previous $5 billion plan. So, what does this actually mean for you as a retail investor? When a $104 billion behemoth like ADP looks at its current valuation and decides, you know what, the absolute best use of our capital right now is to bet on ourselves, well, we need to pay very close attention to the underlying numbers driving that confidence. Here's our roadmap. We're going to cover 1. The ADP situation, 2. Decoding the share buyback, 3. Dividends and earnings growth, 4. The revenue engine, and finally 5. Wall Street's outlook. Let's get right to it. Section 1. The ADP situation. Let's look objectively at the headwinds causing the stock's initial discount. At its absolute lowest, the stock fell as much as 38% from its 52-week high. Why? Well, it comes down to a metric called pays per control. ADP's revenue relies heavily on how many individual paychecks they actually process per client. So, in a weak hiring environment where clients aren't adding headcount, that acts as a direct headwind to their traditional growth model. And last quarter, in aggregate, their clients simply didn't increase headcount. It's just a macroeconomic reality they have to navigate. Moving on to Section 2, decoding the share buyback. To understand management's strategy to combat this pressure, we need to grasp exactly how a share repurchase works. Basically, the company buys its own outstanding stock on the open market and retires those shares. This reduces the total supply, which spreads the company's total value over fewer shares, ultimately increasing the intrinsic value for long-term holders. It's like a pizza, right? If you have the exact same size pizza but you slice it into fewer pieces, well, every slice you own suddenly gets larger and a whole lot more valuable. And ADP isn't just buying back a few shares here and there. That new $6 billion authorization is massive. It represents roughly 5.8% of their entire $104 billion market cap. That gives them a really significant ability to lower the outstanding share count. Actually, if we look back, over the last decade, their share count has steadily declined from 498 million shares down to just 403 million at the end of 2025. Section 3. Dividends and earnings growth. Of course, a buyback is only a good thing if the company actually has the fundamental strength to afford it. You can't return capital you aren't generating. But direct from their latest SEC 10Q filing, we see some brilliantly illustrated resilience. Despite that flat hiring environment we talked about, net earnings actually grew by 9%, and diluted EPS jumped 10%. So they are fundamentally expanding their margins and generating serious profit, even when the macro environment isn't doing them any favors. This brings us to an absolutely crucial point: how buybacks turbocharge earnings over the long haul. While ADP's revenue grew at a solid 8.1% compounded annual growth rate over 5 years, systematically shrinking the share count by 5.9% actually propelled their earnings per share growth to 12.5%. This is the exact mechanism that benefits long-term retail investors. The business grows steadily, sure, but your piece of the pie, it grows exponentially faster. And the capital return doesn't stop with buybacks. On top of shrinking the share count, they also authorized a 10% quarterly dividend increase, pushing it to $1.70 per share. This creates a really powerful dual engine for capital return, marrying the invisible yield of those stock buybacks with the tangible cash yield of a growing dividend. All right, Section 4, the revenue engine. Because let's be real, you can't just financially engineer earnings forever without a real competitive product. The actual engine fueling these returns is their new enterprise platform, Lyric. This helped push Q1 sales up 7% to nearly $5.94 billion. Lyric handles payroll, HR, and workforce management for massive organizations, going head-to-head with rivals like Workday. It's posting rapid pipeline expansion, and here's the absolute kicker. Over 70% of Lyric wins are coming from new logos, meaning companies that have never used ADP before. Paired with their highest client satisfaction on record in Q2, this proves their economic moat isn't just intact, it's actively expanding. So, looking ahead, sell-side analysts project ADP's revenue to grow by a respectable 5.3% over the next 12 months. Now, while that is a slight deceleration from their historical averages, largely due to that flat pays per control metric, it still represents incredibly stable, highly profitable growth for a company of this sheer scale. Which brings us to Section 5, Wall Street's outlook. Wall Street remains heavily divided on how to weigh these opposing factors. The bears have a target of $214. They are focusing intensely on the cooling job market, assuming that PO worksite employee growth stalls out entirely and that pays for control metrics stays perfectly flat. But the bulls, they're targeting way up at $332. They are pricing in the success of the Lyric platform reaching critical enterprise mass and structural EBITDA margins expanding well beyond current projections. They see a company successfully pivoting to higher margin software. When you aggregate all those opinions, the mean analyst target sits right at $267.53. That implies roughly a 30% upside from recent lows. Ultimately, analysts view that raised EPS guidance and the massive $6 billion buyback as incredibly strong anchors that support the stock's valuation, even if the broader job market takes a little while to recover. So, as you evaluate this retail investment thesis for yourself, the ultimate question is whether their aggressive capital returns and undeniable software wins can outpace the broader economic headwinds. Management clearly believes their stock is on sale, and they've literally put $6 billion on the table to prove it. The question is, does their view of the future match yours? Thanks for joining me on this explainer. Keep a close eye on those pays per control numbers next quarter, and keep learning.